VA Declassified Secrets of the Home Loan Benefit, Episode 7, Credit 101. I'm Chris Bettis from Fluent Mortgage, VA Fluently. All right, guys, so last week we kind of shared the secret sauce to fun, almost like a lab. Today is just, we're gonna sit in this classroom, just Credit 101. So I promised it to you, not the most exciting subject, but I know I've harmed myself from a money standpoint when I didn't know this information. I've seen veteran after veteran do what's really common sense, but doesn't match the credit matrix. So I wanna see you win. I wanna see you have the lowest possible rate, buy the most house, or just get out of debt quicker. That's my goal and hope for you. So looking at the screen, credit, well, we'll backtrack just a step. There's a three-legged table, so remember the three-legged table. The one leg we're talking about today is credit. So how we can influence that leg, make it strong and even steady. So here's an example of a credit report. Thank you Credit Plus for years ago, just a great fundamental 101 on your matrix, for sharing information that nobody knew about and for giving us this hypothetical Joseph test case so we can actually see what a credit report looks like. So there's three credit reporting agencies: Equifax, Experian, and TransUnion. Equifax is the West Coast one that affects you and I the most, but for mortgage, we look at all three, which is what's unique. In this case, we got two borrowers right here, a 614, 627, 622. We use the middle credit score, not the average, not a median, but middle. So in this case, 622. Hypothetically, it happens, only two scores. In that case, I would use the 614, the lower of the two scores. Now, spouse or the veteran himself, here's the other set of scores: 757, 763, 771. So super prime, right? Or elite if we're talking VA. Big difference, happens sometimes. So if we need both these people, veteran and spouse, to qualify for the house, this is a score we're using. Well, unfortunately, we go off the lower middle credit score of this to 622. Here's a pro tip for you, and I literally did this myself. My wife has fantastic credit. I said 830, but because of her nature of her business, her score goes up and down because of utilization. We'll see that later. So when we went to buy our last house, her score happened to dip a little bit. She wasn't in the elite category anymore. If we used her, we would have gotten a 0.25% higher interest rate. Thank God, I make enough money on my own. My credit's really steady, stayed at the 830. We were able to put me only on the loan. Okay? We got the super prime, we got the very best, we got the very lowest interest rate. Here's the pro tip. Don't leave your family hanging. Don't let your spouse not be on that home, right? Like, what if, God forbid, something happens to you? Here's the pro tip. NPS, non-participating spouse. So when you write that contract agreement, and if you didn't do it right, I'll protect you, but you go on the loan. You're the veteran. You have to no matter what. So if your score's a lower score, sorry, we're using it. But if you're the better score, we use you, we use your income, we use your COE, you get the loan. We do what's called an NPS, non-participating spouse, and we add them to the title. So you both have legal ownership. So if something happened to you, your wife, your spouse, your husband, your family's safe. That's how we do it. What is credit? It just predicts risk. It just says, hey, what's the likelihood this person is gonna default? They're not gonna pay us back and they're just gonna walk away from their obligation. A big deal for talking about $500,000, right? Or 1.5 or wherever you are in the market with the VA benefit. That's what it's about. And it works, it goes from 300 up to 850. The higher the score, the better. So unlike golf where you want that low score, you want that, remember, 760 to 850. We won't talk about the other tiers for VA last week. Go back to last week. This is just Classroom 101. Within credit, there are 40 different factors that influence that algorithm to make up credit score. But really, they can be summarized into 5 buckets. And as long as you know the 5 buckets for the most part, you've got it. I will dig in a little bit into utilization. So as you can see, more than a third is how you paid, performance. Almost as impactful, and this is the fun one, is utilization. We'll really dig into that one. credit history, type of credit used, and then inquiries. Payment history. Literally, there's nothing more impactful than if you pay somebody back. So like if we had a relationship, if we borrowed money back and forth and we always paid each other, I'm confident we'd slip each other another 20, a C note, something, right? No big deal. I've always paid you back. But if I didn't, you're gonna be way less likely to give me money. And imagine if I borrowed $100 from you and that was the money you're gonna use to pay for your kids to go back into sports, right? Like they've been on lockdown for a year. Like it's really emotionally hard. Like we need sports. And you're like, bro, I'll let you have it, but that's for my kid's school. I need it by Friday. If I don't pay you back, when that happens, furious, right? It so impacts you. Same thing for credit. In the first 6 months, what was done is fresh. It's raw. Huge impact. And if you miss a mortgage or an auto payment, I've seen a 100-point drop. Now, after half a year, 6 months to about 2 years, think of it just like scabbing over, right? Like a wound that's actually healed some. It's scabbed over. It's not completely healed, but hey, it doesn't hurt that much anymore unless it gets hit or knocked or reminded of it. Same thing in that relationship. Past 2 years, you're like, hey, I'll probably never forget, maybe in 7 to 10 years, but for now at least, that's in my past. That's a memory more than emotionally painful to me. Same way with credit. Again, pro tip, nothing can ever have more impact on your credit score than that. So I've had veterans literally not pay credit cards to save up money for a down payment, destroying their score when it's like, bro, you didn't have to put any money down. It's VA. Like we could do this with zero down. There's a method to get you there, and no matter what, you have to pay your bills. That credit is so important to you in life. So if you have anybody talking about that, please tell them to make their payments or have them call me and I'll walk them through the importance of it. I mean, life happens, right? But if you can, please do. Balances, 30% of your score. Utilization. What that means is how much credit you have available versus how much you've used. The less you've used, the better you look. So for buckets, 0, 1, 30, 50, 75, and 100 are the most common ones. And really we're talking about revolving debts, credit cards, things you can borrow and pay back. That's the way we influence credit score. Not an auto loan, not a mortgage. Really on those, only the first 10% affects you. So if you get a brand new car, yes, you can pay it down by 10% and it will affect your score, but past that, doesn't matter. We're talking about revolving debt. So now, 2 different strategies. So first one, using your debt, and this will kind of explain credit utilization. So high credit limit, saying I've got 5 creditors hypothetically, each of them could potentially borrow $5,000 from. 5 times 5 is $25,000. So in theory, I had $25,000 of money I could borrow from people. In this case, I owed $4,000 to one and nothing else to anybody else. So if you look at it as a whole, 4 divided by 25, that's 16%. I've used 16% of the credit available or 16% utilization. That's really good. You're gonna have a higher credit score because of that. After the algorithm or matrix looks at this, it then goes individual by individual by individual by individual. And in this case, one of the trade lines is really high. It's way above 50%. It's above that 75% tier. That's gonna drag down our credit score. Now, if you're trying to get out of debt, this is what you want, right? Hypothetically, let's say it was $4K, $500, $300, $200, $100. Instead of paying a little bit extra to everything, like most of us do, here's the trick to get out of debt and emotionally feeling the best. We pay off that $100 debt. Boom, I'm done. 1 down, just 4 to go, right? And then we take that extra $25 a month and throw out the next one. So we just start attacking that next bucket at 200. Boom, that one's knocked out. Now, when we go over the third one, we've got the extra 25, we've ever got the extra 50. We're throwing 75 extra plus the normal payments that we're going after that one. That one's gone, and you can just see how it just accelerates. And emotionally, you're like high-fiving down to one last card. Then we take the 25, the 50, the 75, the 100 and throw it off to this one, and in a few months, out of debt. That feel good, right? However, if we want to affect credit score, let's say, and I want you out of debt. I don't want you paying interest. Hopefully you get that. But if we need to pivot really fast and we're saying, hey, I'm set up like this, but I need to get my score up just a tiny bit. we'll redistribute. We might be 1,000, 1,000, 1,000, 1,000. Just easy math. We wouldn't do it this way, but as an example. Same 25 and 4. I mean, if you could just pay off the 4K, good to go. Your credit score jumps. Utilization alone. But assuming you have no more money, how do we manipulate or restructure things to get you a better score? 1, 1, 1, 1. Same 16, but we're 20, 20, 20, 20, 0. Your score will raise. Credit history. How long you've had your accounts. So as an example, imagine 2 of your friends came to you and asked you for $100. You're only like, I've got only $100 to my name. I have to pick one of the 2 of you. You're like, well, we're both your friends. You're like, yeah, but Chris, I've known you for my entire life. Joe, I just met you yesterday. We're all friends, but I'm going to honor my relationship with Chris, right? And now let's turn it to credit accounts. If you've had an account for 20 years and they've seen you pay for 20 years, we've got a history of that. We know you can handle it. We know how you're going to perform. If you've never had credit and all of a sudden, bang, there's $20,000 in new debts, I don't know if you can afford life. I don't know if you're going to have character. So a track record of positive history is a big deal. Pro tip, 3 to 5 accounts. That's what you want. So if you don't have any revolving accounts, let's get you a couple. If you have 175 credit cards, right, we probably want to whittle those down a bit. Again, if we have low interest rate accounts that have been around forever, let's keep those. Now, if you want to open up more accounts and you're already at your max or whatever, let me run a simulator. Let me help you with any of this. Please don't damage your credit, whether utilization, whether accounts open, close, whatever, we got you. Types of credit. Didn't hit the slide for some reason, but just so you know, finance cards will just affect you a little bit more. So the type of credit, going to just, let's say you bank with US Bank, a really good bank for veterans. They do a great job, give you free platinum checking, all sorts of good stuff, very reputable. You get one of their cards for credit cards, not too bad on their credit score. But if you have multiple for types of credit, if you got a finance card as an example, will affect your score a little bit more. Lastly, we can't really affect those too much, but we'll run the simulator. So if we're trying to figure out what to close if you had too many, we're probably gonna pick the types of credit cards that are less desirable in terms of score. Lastly, inquiries. Up to 60 points because of it, okay? Every time someone pulls a hard inquiry, and what that means is if they're looking to get new debt, that's gonna affect your score. We'll look at specifics in a second. Soft pulls don't matter. So you pull your own credit, doesn't matter. Your insurance agent you already have an account with, every year maybe will pull your credit to adjust, doesn't affect you. Only new types of credit debt. And it lasts for 12 months. So on your credit report, it's gonna say any inquiries for the last year. Here's the specifics. When a credit card company tries to pull your credit, it's gonna drop 3 to 7 points. Mortgage and autos, anywhere from 5 to 15, so a little bit more impactful. We have to, no matter what, if you wanna buy a house, I'm sorry, we just have to. But some good news. Let's say you went to Brand X out-of-state mortgage company, right? And they're not doing a good job, you're not happy, your realtor's like, please go to Fluent, as an example. Why didn't you go to Fluent? I told you to go to Fluent. And you're like, yeah, we should have gone to Fluent. If it's been within 30 days that they pulled your credit, I can get a snapshot of it and not drop your score. So just know, mortgage at least, you can shop a little bit, okay? And reminder, once that inquiry is there, it's gone for a year, you're not getting it back. It's not like utilization where you can just pay down the balance and you get a do-over in essence. Fun facts. Okay, we're gonna go really fast through a couple different things. Then paying off debt does not remove it from your credit history. We've got a snapshot from 10 years for good debt or 7 years if you haven't paid them well. So again, just because you pay them back does not mean they've forgotten. It's gonna be there for years and years and years and years. Specifically, collections. First off, you're a veteran, we probably won't have to pay off the collections. It's a benefit, not just a loan. Especially if it's a medical collection, because we know VA is supposed to be handling that. Again, you usually do not have to VA. But if you have to, your score is gonna drop. So just imagine that $100 with your son, the whole situation where I borrowed money and didn't pay you back. Let's say a month later, I come bring you $100, right? Right thing to do, shows character. It's gonna be good for our relationship long-term. You get your money, but you're probably not gonna be really happy. It's gonna bring to mind all the pain that I caused your son and you, right? The analogy, wound, ripping off the Band-Aid. It's healed, but when you rip off a Band-Aid, sometimes it hurts, right? Need to be done, it's dirty, throw it away. Long term, that's good, you'll heal quicker, but you gotta rip off the Band-Aid. Same thing, when you pay off a collection, it's gonna drop your score for a second, okay? And that could be the difference between amazing rate to not so amazing, or from a yes to a no. So here's the pro tip if you're working with us. If we have to pay off a collection, not usually, but every now and again, we'll do it in the loan. We won't do it at the beginning before it drops your score. We'll pay it off at closing. So instead of you putting $0 down, maybe we pay that $1,000 collection and you come in with $1,000 cash to close. And ripping off the Band-Aid happens after you get your home. Who cares that it drops a little? And then it starts jumping higher to where it was when you need it again, okay? Again, if we're doing this, we're running a simulator, you're calling me, we're doing it proper. All right, collections and tax liens, 7 years. Judgments, 10 years will stay on your credit and they can renew, so with potential for another 10, so 20. Bankruptcies, chapter 7 and 13, 10 years from the date of discharge, well, filing if it's the 13. Just so you know, you can petition, you can sometimes get off your credit after just 7. Unpaid tax liens, if you owe tax liens, it never comes off. They're gonna get their money. All right, lastly, some information and stats. 80%, 4 out of 5 people have a credit score that can jump. 20% of us, 1 out of 5, actually have wrong information on there. That almost stopped me from getting my first house. There was a Christopher J. Bettis, a John Bettis up in Seattle with bad credit. This Christopher J. had great credit. We were able to fix it, I was able to get my home. So here's my free tool. Here's my free gift to you and thank you for your service. If anybody's ever told you, no, you can't use your VA benefit, call us. We're gonna work with you to help you get your score up. We're gonna work with you to ensure you get to utilize your benefit. And if it's not today, not tomorrow, we will march right alongside with you if it's a month, 2 months, 6 months, or even a year. We got you. We will do whatever it takes to help you earn the benefit that you've earned. So, or at least utilize it, excuse me. All right, guys, that was Credit 101. I know not the most exciting topic, but now you know, right? Not in school, not taught. You can't find it on Google. Here you go. This is the secrets. So what it says is even if you already felt like you knew most of this, please protect someone else that you serve. Please protect a family member. I'm Chris Bettis from Fluent Mortgage. This was VA Declassified Secrets to the Home Loan Benefit, Credit 101, Episode 7. See you next week.